Okay, Sean, welcome to F.A.C.E. Nice to meet you.
Hey Dale, thanks for having me.
Yeah, you ever drink decaf?
Um,
Anyway, I could tell you have a
I
lot
don't.
to. Yeah, I could tell you have a lot to say, and you could go ahead and share your screen if you want. I know you want to talk about the markets here, but before you see the little green button down there.
I do. I don't know if I have. I could. I don't know if I have
You
a
weren't
ton
good.
to. Yeah, I
You don't
don't.
have
I don't. I don't
time.
necessarily have a ton of prepared
Oh, okay.
charts. We
All
we can
right.
talk about whatever you want. We can look at each other's faces if you want.
I'll just
Or we
share a
can leave
screen.
it.
I'll share mine. I'll share my
If
screen.
you would just want to share and just pull
I'll
up.
scroll around.
Yeah,
Oh,
pull up
okay.
whatever chart we're talking about,
Okay.
and
So before
yeah,
we get, I've been on these rodeos. So um, why don't we start with your journey and what were you doing before you
sure.
got into the business, and what was like your first gig?
Well, first of all, it's interesting talking to folks who are focusing a lot on forex, right? So one of my first jobs post college was with Visa, which I'm sure you guys all know who Visa
Yeah.
is, Visa Mastercard. So that
Right.
was when Visa was a private company, a very large private company, and I was actually in the Treasury Department. One of my functions was, hedging, managing, transacting currencies. And that world is a lot different. There were a lot more currencies then. There were a lot more active currencies. So that was pre-euro. And
Okay.
so
Yeah.
that's actually kind of what got me into. Now, I had read a lot of, now don't even ask me how this happened, but I'd probably started reading the Warren Buffett letters probably from around 8th grade freshman year. So I was kind of learning and interested in value investing from a pretty early age relative
Wow.
to most people.
High school,
And
huh?
yeah, I had probably read, like, up to that day, like I had probably read 90% of the Berkshire letters. And that, by the way, that's what I call them. Now they'd be called the Berkshire Hathaway annual reports. And I would
Yeah.
say the best letters were sort of his very early ones, late 60s to probably, I don't know, late 80s. Honestly, once it got kind of into mid 90s, the letters weren't as good, frankly, because it really became a really heavy focus on insurance and float, and that's still super good information. But anyway, so I was pre-med. I decided to go finance econ. Long story short, worked for Visa for a few years. And then I went to work for Verifone. Verifone was a publicly traded company. And then I got into the finance field post Verifone. So I was at Morgan Stanley for a while. And then my last stint kind of for a big company before I basically pretty much been trading full time since 2011. My last stint was with State Farm, another really large private company. And I was in sort of the upper ranks of enterprise risk management functions there. So that was pretty much everything to do with, managing risks, looking at risks, developing programs. A lot of that had to do with a very large equity and bond program. And then,
Okay.
I'd been trading for a number of years before that. And it kind of just morphed into a full-time trading job. And I've been publishing. So I'm the founder and I author a subscription called the Udall Report. There's not much to look at on the website. It's a private Twitter feed mostly. I'm probably going to transition that to something like a Slack room in a few months. So you're showing my Twitter profile.
Yeah.
That's my public profile. I'd say most of my work on Twitter the last few years, last 3-4 years, has been in my private feed. I'm probably going to re-engage on the public side again. But so basically what I do now, I've pretty much been analyzing tech stocks as essentially full time since 2009 to 11 and since. And if you want to trade and invest in tech stocks, the one thing you learn very quickly, if you want to survive, is you also have to have a lot of market awareness. And so I would say my currency background actually helped me a lot. So if you guys want to end up talking about S&P, NASDAQ, and then how many stocks actually don't reflect the indices at all. But so you kind of have to learn to survive. You have to say, you can't just say, hey, I've got a great stock. I've got the next Apple. I can trade it. I can own it and become a multimillionaire. You're going to get blown up. If you don't know how to manage risk and you don't have some market awareness, you can be in the greatest stock in the world.
How do you manage risk, Sean?
God, there's a bunch of ways. The most basic thing I would say for people, I'm not a huge position by position stop loss believer. I think when you're learning, you should probably do that. I'm much more believe a much more effective stop loss strategy is a portfolio stop loss strategy. And the more advanced
What's
you get,
the difference?
Well, I think one, it's just far more. If you basically say whatever let's say you start with 100K. Okay.
Yeah.
Let's say you have a spectacular meme run, right? Or a spectacular, run where you double or triple or quadruple your account. Then you can say, hey, from here, I'm going to tolerate a certain drawdown from here. So let's say if you say it's a 5% drawdown, you're going to probably sell your whole account out every other day. So, but if you say, hey, I've doubled up or tripled up, maybe 25%, 20%, 50, whatever.
Well, what if you have no profits and I'm giving you 100K today? How would you manage the risk?
Yeah, I think you have to use probably three things. You have to use a blend. I still almost think you could kind of do the same thing. One, you're not going to put all that money to work in one day, hopefully. Two, I do think you probably have some position limits and some individual risk metrics, meaning individual stops and things like that. But I still think you could basically use that same approach. You could say, hey, if I'm down 15, 20% on this 100K, I've got to reassess things, right? And then, but I really do. I think that's more effective because if you're putting a loss on every single or a stop on every single trade, what you're basically doing, we could get into algos because that's what I've really become an expert
they'll
at.
take you out on stop.
They will. They'll basically take you out of every single trade effectively, right?
Okay.
So, but I really do. I think in fact, one of the best tips I could give to new traders is learn about a portfolio stop loss strategy as opposed to an individual position stop loss strategy.
Okay. Yeah, I think that makes sense too. So I'm getting from what your comments were prior to the interview, you said everyone who had to get out is out. And, I noticed these divergences here the other day. What's your view on NASDAQ here? Where are we going?
Well, so here's my view on NASDAQ in 3 bullet points. One, I would compare the NASDAQ versus something like the IWM or the IWO. So one, I would compare it versus other things. Two, I would compare it versus how many stocks are down anything like the NASDAQ. I mean, I'm in a bunch of stocks right now that look nothing like the NASDAQ because I like kind of smaller to mid cap. Now, mid cap now can be as much as 20, 30 billion bucks, but I used to own Apple. I don't own Apple anymore, right? I used to own Facebook. I'm not interested in those names anymore. But I would say as far as the chart of the NASDAQ, at least it's a little more reflective of the underlying damage because one of your other guys said it was down 23% at the max off of highs. That's at least somewhat more reflective of what's really going on in the real world, if you will. The one thing I'm going to transition and talk about the S&P for just 3 seconds. The S&P is like just in a land of its own. There's no index that's down this little. The IWM I think was down like 25 to 27%. The IWO was probably down 30 some percent.
You think there's a pairs trade like being long the Russell IWM against NASDAQ?
Yes, I was just going to mention that one of my big themes is, in fact, if you were to pull up an IWM versus QQQ ratio chart, that chart has literally been going down since the 4th quarter of 2007. Now, just think about that.
Yeah.
Now, the 4th quarter of 2007 to now is 15 years. So put it this way, there were some people who wanted me to call a bottom in December, January. I'm like, no way, right? And just to give you some background, I was raising cash in October, November, I was cash. Now, did I raise as much as I wish I would have? no way. I wish I would have raised 2 to 3 times. At least I was raising cash at a good time. But the one thing I was looking at is like at the end of last year is, man, look at how cheap just these, let alone individual small and mid cap growth stocks are, but how cheap even just the index like the IWM is relative to every other index on the planet. Now, the US indices, I'm not as expert. I don't think the DAX, for example, has gone up near what the NASDAQ has gone up since the COVID lows, probably not even close. Yeah. So, you know, we're talking about certain indices that obviously had an overshoot phase. But if you, looking at longer out, I would say there's almost no way that something like the IWM doesn't have very meaningful performance versus something like the S&P. Like, I literally don't know, Dale, how the S&P is only down 10%. I think the max drawdown in this cycle is minus 12.8 or something, maybe 13. Yeah. And that was an intraday low, which I think we bounced 4% off of that day. So it's just really, really strange. It's a really, like, the comparison period I've been using to now is 2016. The damage to most stocks now is much greater than 2016. But it was the same kind of market. The S&P held up pretty well. NASDAQ was quite a bit worse. But there were a lot, like the whole biotech, biotech index was down 67% from top to bottom. I'm trying to think, there was another index that was down huge. Like if you take out mega cap tech stocks back then, like the average, it was kind of like now. There was a huge percentage of NASDAQ stocks that were down 50 to 60%. Right. So, like, I don't think people are aware of this. I'm not joking. When I say 50% of the NASDAQ is down 50% or more, that's really accurate. It's probably like 46 or 47% of the entire NASDAQ is down more than 50%. That, just so you know, that's only ever occurred in full-blown crashes. So it's very, like, so outside of the S&P, you basically have a market crash that nobody's talking about. So
you feel that way about that way about semis too?
No, it depends on the semi, right? So
well, like SMH looks pretty good.
It looks better. What you tell me? The SMH is probably down a little bit more than the NASDAQ. SMH probably did minus 25. So at least that's a little more reflective. But look at, like, a stock like Intel is one of my favorite semis right now. And there isn't a person in the world that likes Intel. So
because it's an old name, right?
Probably because it's an old name, but I think more because of sort of everybody now is kind of geared into recency bias and momentum and what's working now. And you know, I think everybody's going to get taught a big lesson, actually. I think the chasing of performance and the chasing of momentum, I don't think has ever been more popular than it has been really in the last 18 months.
Okay, especially in the commodity complex. And another comment you made during our analysis was, you're the only one left that believes inflation can be transitory. So
sure,
tell us about that and why you think it is.
Well, I think the best way to sort of express that, now, this is probably going to be the most disagreed with comment I make in this whole interview with you. I actually think
I think there's going to be a breather. Oh, at least. Go ahead.
A breather meaning?
Sharp corrections.
Oh,
for another wave up.
For sure. In fact,
commodities.
Yes. Okay. So, but
it's already started in crude.
I actually think the Fed had it right when they said inflation was transitory. Now we can make fun of the Fed and say how wrong they were and how late they were in raising rates and things like that. They're very behind the curve, obviously. But I really do think
we're not saying it. Jay Powell is saying it now.
Okay. Well, there's lots of people who would, the popular opinion, I think the popular media opinion would be that the Fed's
behind the curve. Right.
Exactly. Okay. So let's talk about commodities and inflation. If we didn't have the COVID crisis and people not showing up for work, people not working, ships not being unloaded, et cetera, et cetera, et cetera, would we have much inflation right now? I would say, well, there's always some. and inflation's almost always kind of understated, right? That's the argument from some people is like, well, inflation's not measured correctly, blah, blah, blah. But you have to take things as they are, right? But the inflation numbers as they are largely a function of COVID, supply chain, all these things that frankly have nothing to do with the interest rate curve. They just don't. And then the Ukraine war was almost like the Ukraine invasion was sort of like the final cap on top of things that made inflation even worse than it was already, right? So you just mentioned oil. Wouldn't you think oil should have held better? I mean, what is it, $30 off of highs already?
Yeah, I think we're going to 85, 80.
Yeah, we might even go back to 65, 75. I mean, let's say there's a resolution to Ukraine relatively soon. By the way, I don't expect that, but let's say there is. At that point, I don't know. Is there really that much oil usage that the world can't handle? And so anyway, and we could talk. I mean, lumber has had this massive move. The one part of inflation that the Fed might be able to do something with would be like housing. I think the Fed is afraid
stocks.
Yeah, and absolutely.
But I mean, how can the Fed create more corn? They can't print it.
They can't create more lumber.
How do higher interest rates reduce? Is it going to be demand destruction? And people are saying, well, it's not going to be I don't want to eat. It's going to be I can't afford to eat.
That's right. So if you believe the Fed, if you believe that they're actually going to be able to raise 25 times.
I don't. I play Johnny Lang's song "Lie to Me." Check it out,
so,
man.
But I mean, they're what are they calling for? 25 hikes? I'm sort of exaggerating, but it's almost like what they're saying. They're going to hike 25 times now. So, yeah. But here's the one thing the Fed, I think, has done effectively. What's one of those powerful tools of the Fed? It's called jawboning. Jawboning is talking about lots of things, and the more effective they are at it, the less they might have to do. Like, do you really think the Fed really wants to take rates to 2 or 3 or 4% in a world where there's so much debt that they're going to have to refi? You think they want to refi a bunch of US paper at 4%? I mean, come on. So, but that's another topic. But I think if you don't get, if you just get, let's say, half of the COVID stuff taken care of, I think roughly half of the inflation numbers probably go away. Now, that doesn't mean we're going to go back to sub 2%, but I think you get down. I think the realistic inflation is probably down more closer to 4 to 5. So there's like 3 things. But by the way, if you're, I'm sure you pay attention to this. How many economic data points are showing strength anymore? Like the Empire Index 2 months in a row has been negative. And like massively missing expectations. So I think what's going to happen with inflation is basically going to take care of itself, because the seeds of inflation's downfall were already in the system before the Fed made the hawkish pivot.
So would you short gold and silver in the miners?
I actually said when oil was around 125 and climbing, I said I thought energy stocks were a good short-term short. Gold's tough for me because it's not a central part of what I do. I do think maybe in 3 months or something, I would start thinking about something like that. For me, I'm probably not going to do that. Here's the differential. So I don't look at gold as much as I used to, but I do look at the commodities. I would say, would you rather buy a tech stock trading at 1.5 or 2 times sales or 3 times net cash, which has, with lower growth, has 15 to 20% growth versus, let's say, 30 or 40 or plus? So would you rather buy a tech stock with 15, 17, 18% growth trading 4 times cash, or would you rather try to short gold? So that's my world, right? Because I know tech stocks and I know lots of stocks.
Right.
One thing I might add would be, I think everybody's going to go crazy on finance stocks, and they kind of have. So this is something I more directly know. So this comes from, I was buying finance stocks in 2009 and 10. I was selling them 15, 16. I was buying finance stocks post-COVID. I sold them all October, November, December. Most of that was sold December. Everybody seems to love finance stock. You could pull up the KRE. That's the regional bank index. You could pull up JP Morgan. I don't know, whatever. But
yeah, they're all getting hammered. Do you think there's systemic risks from what we did with sanctions? And are you worried about the Russians defaulting?
No, what I'm worried about is if there's any truth to what I'm worried about is if there's any truth to the Fed raising that much. You're the worst sector to be in if there's a whiff of a recession is the bank stocks. Mm-hmm. I mean, if you can just go look any time we've had a recessionary pulse, even when we don't hit a recession, but people think we might, at some point the bank stocks become the worst stocks to be in. So that's more why I sold all my bank stocks. So now systemic risks, I actually don't think that's much of a factor for US banks. My guess is, and I've looked at the Euro Stocks Bank Index, I think it was down 25 to 35% in about a 2-week period of time as of like last Friday. So I don't know if I could put money in any European bank. I think European banks might have a fair amount of systemic risk. The US banks are pretty, like the Citibank had a report. They have something like less than 0.8% of their total book has exposure to, for example, Russia. That's super, super minimal exposure. So I think the US banks are, I don't know if they were mandated to not lend, but they just don't have hardly any exposure to that part of the world. So, but I just think it's a bad place to be on a relative risk. On a risk reward basis, I think bank stocks are a bad place to be. And that's where what everybody's rushing into. And that's what everybody thinks the trade is now on higher interest rates.
Okay, so bear market rally in S&Ps or new highs?
That's kind of what I think. I think you're going to have a hard time. I almost think S&P has to catch up to the broad damage that, again, you basically have outside of the S&P, pretty much you can almost say anything with a market cap less than 50 billion, which is still pretty big, is basically in a crash. So, I think the rest of the world kind of has to catch up, or the S&P has to kind of catch up to the rest of the world. So I wouldn't be a bit surprised. Are you old enough to remember 08 and 09?
Yeah.
Okay, so stocks bottomed well before March of 09. The S&P put the mark of the beast bottom in March of 09. Yeah. But most stocks, especially the tech sector, probably bottomed 4 to 7 months. I'm going to say, maybe let's just use 6 months, give or take a month or two. So what happened is a lot of stuff started working higher. A lot of stuff at least started holding. And then what happened is you basically had one last kind of worry on the finance sector. The powers that be realized that an accounting rule was causing more damage than anything they could fix. So they basically repealed FAS 157. People could go look that up. FAS 157 was mark-to-market accounting. And that was, in my view, a much bigger reason for the financial crisis than, people buying 5 condos in Florida.
Yeah.
So
you think real estate could get hammered again?
I think real estate is the next shoe to drop. I don't know. It's tough to say. Is it like, are we going to go into an 08 period? I actually don't think so. But I think stocks are acting like it. The average stock is acting like it's pricing in a recession. So back to the whole rally, right? Back to why did we rally so much off the Fed meeting? I think like everybody that was forced to sell had sold at least short term. I think the average stock has actually priced in or more than priced in a recession. NVIDIA, I don't think is priced in a recession. I don't think Snowflake has priced in. Even Snowflake is down a ton. But these are these very high, high multiple stocks.
Yeah.
But I think the average stock has likely priced in a recession. So now we're going to be on recession watch, I think, for the next like 4 to 8 months. So my guess is, as other stocks don't go lower, if we do start having more recessionary pulses, I think the next 3 months, you're going to have a lot of economic data that's not nearly as rosy as the Fed says it's going to be. And then I think there's a lot, what is really carried the S&P in effect? There is a lot of tech in the S&P today, but there's still a lot of finance. There's still a lot of energy. So you got finance and energy is basically supporting the S&P. So if oil goes down and the energy sector goes down, and then bank stocks go down, there's not very much underpinnings on the S&P anymore.
Okay, so you're bearish here.
I'm bearish on the S&P. I'm probably neutral to getting bullish on small and mid cap growth stocks.
Okay. All right. Well, we have to wrap it here, Sean. I appreciate your time. Best way for people to reach you is on your Twitter handle.
Yeah, just use the Twitter handle, and then what usually happens is I start, people use Twitter, they follow me. Again, I'll probably get more active on it, and then but through that they can DM me or whatever, and then if anybody's interested in my subscription, they can contact me through that. But it's been great. Okay. Again, I wanted to thank you because it's very rare, very refreshing to hear lots of currency talk, because hey, you can learn a lot from it. I probably will. You can learn a lot from it, and it does have a lot to do with what's going on in the world.
Sure does. The world revolves around the dollar.
It does. It does. By the way, before I go, is the dollar reflecting all these rate hikes yet? These supposed rate hikes?
I think the dollar is peaking out here.
See, that's very anti to if the dollar believes that the Fed's going to hike 25 times again. Okay, 12 times. I would think the dollar would be ripping versus every currency on the planet. Wouldn't that be the expected move?
Well, it depends what the rest of the central banks do.
That's true.
And there's other factors besides interest rate differentials.
Well, yes, yeah.
So
yeah.
So I think the euro is bottomed.
Interesting. So you like the euro? You think the dollar's peaking, and you basically don't think the Fed's going to do as much, and the euro economies will basically survive the Ukraine invasion. Is that kind of your base case?
Yeah.
Yeah. Okay. Well, hey, thanks again for having me. You want to have me on? I appreciate the invite.
All right. Well, thank you, Sean. So Sean Udall, everybody, could follow him at Udall Tech Strat.
You got it.
Okay.
Take care, everybody.
All right. Good hunting. You've survived an interview with me, Sean. You know what that makes you?
Tell me.
My trading warrior brother.
Hey, I like it.
All right, buddy. You're in the club.
All right, later.
All right, everyone. Remember, don't just count your pips, count your blessings. I'll see you tomorrow. I have a interview with Rohit from at India Charts, which one of you guys requested. I bring him back, so he'll be with us tomorrow. Happy Purim, Amira. Happy Purim. Go grab an apple for me. And that's going to be a wrap. See everyone tomorrow. Join the team in 14 minutes on the Morning Edge and get sharp. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.